Question 1. Which of the following statements about activities of daily living adults as they relate to long-term care insurance (LTCI) is true? A. DLS only include physical activities such as bathing and dressing. B. Cognitive impairment does not affect the determination of eligibility for benefits. C. A person must be unable to perform at least 2 a DLS to qualify for benefits. D. A DLS are defined solely by the insurance company and do not follow any regulatory standards. Answer: C. A person must be unable to perform at least 2/8 DLS to qualify for benefits. Explanation: in long-term care insurance, activities of daily living adults are critical in determining eligibility for benefits. Typically, most policies require that the insured be unable to perform at least 2/8 DLS to qualify for benefits. The 6 primary DLS include bathing, dressing, eating, toileting, transferring, and continence. Option is incorrect because a DLS also include cognitive abilities, as cognitive impairment can trigger benefits under most policies. Option B is incorrect, as cognitive impairment, such as dementia, is a recognized factor that can qualify a person for benefits. Lastly, option D is inaccurate because while insurance companies may define their specific terms, regulatory standards guide ADL definitions. Question 2. Which of the following is NOT a required disclosure for long-term care insurance policies in Colorado? A. A written outline of coverage must be provided to the applicant. B. The insurer must disclose the policy's renewal provisions. C. The insurer must guarantee coverage until the policyholder reaches age 100. D. The insurer must provide information regarding the policy's elimination period. Answer: C. The insurer must guarantee coverage until the policyholder reaches age 100. Explanation: in Colorado, insurers are required to provide several disclosures to ensure transparency and consumer protection. However, there is no mandate requiring insurers to guarantee coverage until the policyholder reaches age 100. Instead, policies typically include provisions for renewal and may have limitations based on the terms of the contract. Options A, B, and D are correct as they represent required disclosures under Colorado's long-term care insurance regulations, including providing a written outline of coverage, informing applicants about renewal provisions, and details on the elimination period. Question 3. Scenario-based. Mr. Anderson is 75 years old and has recently purchased a long-term care insurance policy. After a fall, he is diagnosed with early-stage Alzheimer's disease. He contacts his insurance agent to file a claim for in-home care assistance. What should Mr. Anderson do first to ensure his claim is processed efficiently? A. Immediately hire a home health care provider and submit the bill for reimbursement. B. Obtain a physician's certification that confirms his need for care. C. Wait for the insurance company to contact him regarding the claim process. D. Review the policy for specific exclusions related to cognitive impairments. Answer: B. Obtain a physician's certification that confirms his need for care. Explanation: in filing a claim for long-term care insurance, obtaining a physician's certification is a critical step. This documentation confirms Mr. Anderson's condition and his need for in-home care assistance, which is necessary for the claim adjudication process. Option A is not advisable, as he should not incur expenses without prior approval of benefits. Option C is incorrect because he should proactively gather the required documentation rather than waiting for the insurer to initiate contact. Option D, while relevant, does not provide the immediate action needed to facilitate the claim process. Understanding the claims process and the requirement for physician certification is essential for successful claims in long-term care insurance. Question 4. In Colorado, which of the following provisions is typically included in long-term care insurance policies to protect consumers from loss of benefits? A. Elimination period provision. B. Non-forfeiture benefits provision. C. Subrogation clause. D. Waiver of premium provision. Answer: B. Non-forfeiture benefits provision. Explanation: non-forfeiture benefits provisions are designed to protect policyholders from losing their benefits if they stop paying premiums after a certain period. These provisions may allow for benefits to be reduced rather than forfeited altogether. Option A, the elimination period, is the duration before benefits commence, not a protection against loss of benefits. Option C refers to a legal right of an insurer to pursue a third party responsible for a loss. It does not provide consumer protection in the context of LTCI. Option D, the waiver of premium provision, allows for premiums to be waived during periods of confinement but does not necessarily guarantee benefits if the policy lapses. Question 5. What is the purpose of Colorado's partnership program for long-term care insurance, and how does it benefit policyholders? A. To provide financial assistance to low-income individuals needing long-term care. B. To allow policyholders to qualify for Medicaid without a spend down of their assets. C. To guarantee that all long-term care services will be covered by insurance. D. To restrict the sale of LTC insurance to only qualified agents. Answer: B. To allow policyholders to qualify for Medicaid without a spend down of their assets. Explanation: Colorado's partnership program is designed to encourage individuals to purchase qualified long-term care insurance policies. One of its significant benefits is that it allows policyholders to qualify for Medicaid without having to spend down their assets, thereby protecting their estate from being depleted by long-term care costs. Option is incorrect because the partnership program does not provide direct financial assistance. It incentivizes private insurance. Option C is misleading. While the program encourages coverage, it does not guarantee all services will be covered. Option D, while relevant to agent qualifications, does not describe the primary purpose of the partnership program. Question 6. Which of the following statements about inflation protection options in long-term care insurance policies is true? A. All long-term care insurance policies are required to include inflation protection. B. Inflation protection options can only be compound, not simple. C. Policyholders can choose between simple and compound inflation protection options. D. Inflation protection increases the daily benefit amount only at the policyholder's discretion. Answer: C. Policyholders can choose between simple and compound inflation protection options. Explanation: Inflation protection options are crucial for long-term care insurance as they help maintain the purchasing power of benefits over time. Policyholders typically have the option to select either simple or compound inflation protection. Option is incorrect because not all policies are mandated to include inflation protection. It's an option. Option B is false since both simple and compound options exist. Option D misrepresents the nature of inflation protection. Increases are typically defined by the policy rather than at the policyholder's discretion. Question 7. In Colorado, which of the following is a requirement for long-term care insurance marketing practices? A. All advertising must be approved by the Colorado Department of Regulatory Agencies, DORA. B. Insurers can market their policies as Medicare supplements without additional disclosures. C. Agents must provide a written shopper's guide to all potential purchasers. D. Marketing must include guarantees of coverage for all long-term care services. Answer: C. Agents must provide a written shopper's guide to all potential purchasers. Explanation: Colorado law requires agents to provide a written shopper's guide to potential purchasers of long-term care insurance, which helps consumers understand their options and make informed decisions. Option A is incorrect. While advertising practices are regulated, not all advertising requires pre-approval. Option B is misleading as Medicare supplements have distinct requirements and cannot be marketed as such without proper disclosures. Option D is incorrect. Insurers cannot guarantee coverage for all long-term care services due to policy limitations and exclusions. Question 8. Which of the following criteria is NOT typically used to determine the benefit triggers for long-term care insurance policies? A. Cognitive impairment, such as Alzheimer's disease. B. Inability to perform two or more activities of daily living adults. C. A specified number of hospital stays in a year. D. A physician's certification of need for care. Answer: C. A specified number of hospital stays in a year. Explanation: Benefit triggers for long-term care insurance policies typically revolve around cognitive impairment, the inability to perform adults, and a physician's certification. A specified number of hospital stays is not a common criterion for triggering benefits in LTCI policies. Therefore, option C is correct. Option A is true as cognitive impairments are valid triggers. Option B is accurate as the inability to perform two or more ADLS is a standard trigger. Option D is correct. A physician's certification is essential for claims processing. Question 9. What is a key difference between qualified and non-qualified long-term care insurance policies in terms of tax implications? A. Only qualified policies provide tax-free benefits. B. Non-qualified policies are fully tax-deductible. C. Qualified policies do not require any premiums to be paid. D. Only non-qualified policies can accumulate cash value. Answer A. Only qualified policies provide tax-free benefits. Explanation: Qualified long-term care insurance policies allow for tax-free benefits under the Internal Revenue Code, providing significant tax advantages for policyholders. Option B is incorrect because non-qualified policies do not enjoy the same tax deductions as qualified policies. Option C is misleading. All policies require premium payments as stipulated in the contract. Option D is false. Qualified policies generally do not accumulate cash value, which is a characteristic often associated with non-qualified policies. Question 10. Mr. Taylor is reviewing his long-term care insurance policy and notices that certain services are excluded. Which of the following is a common exclusion found in most LTC policies? A. Care provided by licensed health professionals. B. Care received in a hospital setting. C. Care provided by family members. D. Custodial care in a nursing facility. Answer: C. Care provided by family members. Explanation: many long-term care insurance policies commonly exclude care provided by family members to prevent potential conflicts of interest and financial abuse. Option is incorrect because care provided by licensed professionals is typically covered. Option B is also incorrect as hospital care is generally covered under most policies. Option D is misleading. Custodial care in a nursing facility is usually covered, making option C the correct choice. Question 11. Which of the following statements best describes the concept of insurable interest as it applies to long-term care insurance policies? A. The insured must have a financial stake in the insured's health or life. B. Insurable interest is only required at the time the policy is issued, not at the time of claim. C. A family member must be the policyholder for insurable interest to exist. D. Insurable interest requires that the policyholder has a controlling interest in the insured's assets. Answer A. The insured must have a financial stake in the insured's health or life. Explanation: insurable interest is a fundamental principle in insurance, ensuring that the policyholder has a legitimate interest in the insured's life and health, which helps prevent insurance fraud. This principle is particularly relevant in long-term care insurance, where the policyholder may need to demonstrate that they would suffer financial loss if the insured were to require long-term care. Option B is incorrect as insurable interest must exist both at the time of the policy's inception and during the claims process. Option C is misleading because insurable interest does not mandate that the policyholder be a family member. They could be a business partner or another party. Option D misinterprets the concept as it pertains to asset control rather than health or life interest. Question 12. Which of the following is true regarding the waiver of premium provisions in long-term care insurance policies in Colorado? A. Premiums are waived only after a 90-day waiting period. B. Waivers are automatic upon the onset of long-term care. C. The waiver applies if the policyholder is receiving benefits for a specified time. D. Waiver of premium provisions is not allowed under Colorado law. Answer: C. The waiver applies if the policyholder is receiving benefits for a specified time. Explanation: a waiver of premium provision typically stipulates that premiums will be waived after the policyholder has been receiving long-term care benefits for a specific duration, often 30 or 60 days. Option A is incorrect. The waiting period is not universally set at 90 days. Option B is misleading because waivers are not automatically granted at the onset of care. The specific conditions must be met. Option D is incorrect. Colorado law allows for such provisions in long-term care insurance policies. Question 13. What is a common requirement for a long-term care insurance policy to be classified as a qualified policy under federal tax law? A. It must provide coverage for skilled nursing care only. B. It must include a minimum daily benefit amount. C. It must meet specific consumer protection standards set by the state. D. It must provide coverage for at least 12 consecutive months. Answer: D. It must provide coverage for at least 12 consecutive months. Explanation: for a long-term care insurance policy to be classified as a qualified policy under federal tax law, it must provide coverage for a minimum duration of 12 consecutive months. This classification allows the policyholder to receive favorable tax treatment, such as tax-free benefits. Option is incorrect because qualified policies can cover various types of care, not just skilled nursing. Option B is misleading. While many policies have a daily benefit amount, this is not a defining factor for qualification. Option C is somewhat true but does not address the minimum coverage duration, making D the best answer. Question 14. Mr. Smith is considering a hybrid long-term care insurance policy. What distinguishes a hybrid policy from traditional LTC policies? A. Hybrid policies exclusively cover nursing home care. B. Hybrid policies combine life insurance benefits with long-term care coverage. C. Hybrid policies have no premium costs. D. Hybrid policies are only available to individuals over the age of 65. Answer: B. Hybrid policies combine life insurance benefits with long-term care coverage. Explanation: hybrid long-term care insurance policies are unique in that they combine traditional life insurance with long-term care benefits. This allows the policyholder to have a death benefit while also ensuring that they have access to funds for long-term care if needed. Option A is incorrect, as hybrid policies are not limited to nursing home care. They typically cover various long-term care services. Option C is misleading, as hybrid policies require premiums similar to traditional policies. Option D is incorrect, as hybrid policies are available to individuals of various ages, not limited to those over 65. Question 15. Which of the following correctly describes the difference between skilled nursing care and custodial care under long-term care insurance policies? A. Skilled nursing care requires the supervision of a licensed healthcare professional, while custodial care does not. B. Custodial care is only provided in hospital settings, whereas skilled nursing can occur at home. C. Skilled nursing care is less expensive than custodial care. D. Custodial care includes services that could be provided by untrained individuals. Answer A. Skilled nursing care requires the supervision of a licensed healthcare professional, while custodial care does not. Explanation: skilled nursing care involves medically necessary services provided by licensed healthcare professionals, such as nurses, while custodial care consists of non-medical support, such as assistance with activities of daily living, adults, and can be provided by unlicensed individuals. Option B is incorrect, because custodial care can be provided in various settings, including home care. Option C is misleading. Generally, skilled nursing care is more expensive due to the level of training required for the providers. Option D is true, but does not encompass the full distinction between the two types of care as outlined in the question. Question 16. What is the purpose of a free look period in long-term care insurance policies? A. To allow policyholders to cancel their policy without penalty within a specified time frame. B. To provide a grace period for missed premium payments. C. To ensure that policyholders can change their coverage options after purchase. D. To require insurance companies to provide additional disclosures. Answer A. To allow policyholders to cancel their policy without penalty within a specified time frame. Explanation: the free look period is a consumer protection feature that allows policyholders to review their long-term care insurance policy for a specified period, typically 10 to 30 days after receiving it. If they decide the policy does not meet their needs, they can cancel it without penalty and receive a full refund of any premiums paid. Option B is incorrect. Grace periods pertain to late premium payments but are not the same as a free look period. Option C is misleading, as the free look period does not grant the ability to change coverage options. Option D is incorrect. While additional disclosures are important, they are not the purpose of the free look period. Question 17. Which of the following is a primary reason for the Colorado Department of Regulatory Agencies, DORA, to oversee long-term care insurance providers? A. To guarantee profitability for insurance companies. B. To protect consumers from unfair practices and ensure compliance with state regulations. C. To limit the number of insurance providers in the state. D. To promote the sale of long-term care insurance as a primary funding source for Medicaid. Answer: B. To protect consumers from unfair practices and ensure compliance with state regulations. Explanation: DORA's oversight of long-term care insurance providers is essential for protecting consumers by enforcing regulations that prevent unfair or deceptive practices and ensuring that providers comply with Colorado's insurance laws. Option is incorrect, as DORA does not guarantee profitability for any insurance company. Option C is misleading. While DORA regulates the market, it does not necessarily limit the number of providers. Option D is incorrect. The role of DORA is not to promote long-term care insurance as a funding source for Medicaid, but to ensure fair practices in the market. Question 18. Which of the following options is NOT considered the valid method for filing a claim under a long-term care insurance policy? A. Submission of medical documentation and a physician's certification. B. Providing a verbal notice to the insurance company. C. Completing a claim form provided by the insurer. D. Sending a written notice of the claim via certified mail. Answer: B. Providing a verbal notice to the insurance company. Explanation: To properly file a claim under long-term care insurance policy, a policyholder must typically submit medical documentation, complete a claim form, and may also need to send a written notice via certified mail to ensure a record of the claim. Providing a verbal notice, option B, is insufficient and may not be documented or acknowledged by the insurer. Therefore, it is not considered a valid method for filing a claim. Options A, C, and D are all acceptable methods for submitting claims. Question 19. Which of the following best explains the coordination of benefits in relation to long-term care insurance? A. Long-term care insurance policies will automatically cover all costs after Medicare benefits are exhausted. B. Coordination of benefits determines how different insurance policies interact to cover the same healthcare expenses. C. It restricts policyholders from using more than one long-term care insurance policy simultaneously. D. It prevents policyholders from switching between long-term care insurance providers. Answer: B. Coordination of benefits determines how different insurance policies interact to cover the same healthcare expenses. Explanation: Coordination of benefits is a process used to determine the order in which multiple insurance policies will pay for covered services when an insured has more than one policy. It ensures that benefits do not exceed the total amount of the covered expenses. In long-term care insurance, coordination of benefits is particularly important when policyholders have multiple plans, as it outlines how claims will be paid and which insurance will pay first. Option is incorrect because long-term care insurance does not automatically cover costs after Medicare benefits are exhausted. The specifics depend on the policies in question. Option C is misleading. Policyholders can have multiple long-term care insurance policies, but coordination will determine how they interact, not restrict usage. Option D is incorrect. Coordination of benefits does not affect a policyholder's ability to switch between providers. Question 20. What is the primary purpose of state-mandated long-term care insurance training requirements for agents and brokers in Colorado? A. To increase the sales of long-term care insurance policies. B. To ensure that agents and brokers understand the complexities of long-term care insurance products and can inform consumers effectively. C. To limit the number of agents selling long-term care insurance policies. D. To require agents to sell only one brand of long-term care insurance. Answer: B. To ensure that agents and brokers understand the complexities of long-term care insurance products and can inform consumers effectively. Explanation: State-mandated training requirements are designed to equip agents and brokers with the necessary knowledge and understanding of long-term care insurance products, ensuring they can guide consumers in making informed decisions. This training addresses the nuances of policies, benefits, exclusions, and consumer protections. Option is incorrect. While training may contribute to increased sales, that is not its primary purpose. Option C is misleading. Training does not limit the number of agents, but rather aims to enhance their competency. Option D is incorrect, as training does not mandate agents to sell a specific brand of insurance. Question 21. When assessing an applicant for long-term care insurance, which of the following factors is typically not considered? A. The applicant's age and health status. B. The applicant's lifestyle and personal habits. C. The applicant's preferred long-term care settings. D. The applicant's credit score. Answer: D. The applicant's credit score. Explanation: When evaluating an applicant for long-term care insurance, insurers commonly consider factors such as age, health status, and lifestyle habits, as these can influence the likelihood of needing long-term care. However, an applicant's credit score is generally not a relevant factor in determining eligibility or premiums for long-term care insurance. Options A, B, and C are all critical factors that insurers assess to determine risk and appropriate coverage options. Question 22. In Colorado, what is a required disclosure that long-term care insurance providers must make to potential policyholders? A. The maximum benefit period allowed under the policy. B. The amount of commissions paid to the selling agent. C. The financial stability rating of the insurance company. D. The total premium amount for the policy over its lifetime. Answer A. The maximum benefit period allowed under the policy. Explanation: Insurance providers are required to disclose important policy details, including the maximum benefit period, which informs policyholders how long coverage will last if long-term care services are needed. This transparency helps consumers make informed decisions. Option B is not typically required, as commission details are generally internal matters. Option C, while important for overall company evaluation, is not mandated for disclosure in the same way that benefit periods are. Option D is misleading. While total premium costs are important, they can vary based on the duration of coverage and policyholder choices. Question 23. Which of the following scenarios would likely trigger a benefit payment from a long-term care insurance policy? A. An individual is hospitalized for surgery and receives post-operative care at home. B. A policyholder requires assistance with activities of daily living adults due to chronic illness. C. A family member provides care to the policyholder without any formal agreement. D. An individual is diagnosed with a terminal illness but does not yet require long-term care. Answer: B. A policyholder requires assistance with activities of daily living adults due to chronic illness. Explanation: benefit payments from long-term care insurance policies are typically triggered when a policyholder is unable to perform a certain number of DLS, such as bathing, dressing, eating, etc., due to chronic conditions or disabilities. Option A may not trigger benefits unless the care qualifies under the policy's terms, as hospitalization alone does not suffice. Option C is incorrect. Benefits usually require formal care agreements with licensed providers. Option D does not qualify for benefits, as the diagnosis alone does not trigger coverage without a need for long-term care services. Question 24. What type of care is generally NOT covered by long-term care insurance policies? A. Nursing home care. B. Assisted living facility care. C. Home health care. D. Emergency room visits for acute medical conditions. Answer: D. Emergency room visits for acute medical conditions. Explanation: long-term care insurance is designed to cover services related to long-term care, such as nursing homes, assisted living, and home health care, but it typically does not cover acute medical care like emergency room visits. These services are usually covered by health insurance policies rather than long-term care insurance. Options A, B, and C are all valid types of care that these policies are intended to cover, focusing on long-term support rather than immediate medical emergencies. Question 25. Which of the following statements about inflation protection in long-term care insurance policies is true? A. All long-term care insurance policies automatically include inflation protection. B. Inflation protection options can help policyholders keep pace with rising long-term care costs. C. Inflation protection is only available for policies purchased by individuals under 50 years of age. D. Inflation protection increases premiums but guarantees a larger payout upon claim. Answer: B. Inflation protection options can help policyholders keep pace with rising long-term care costs. Explanation: inflation protection is an important feature that allows policyholders to adjust their benefit levels to account for inflation and rising long-term care costs over time. It can come in various forms, such as automatic increases or optional riders. Option is incorrect because not all policies automatically include inflation protection. It may need to be selected as an option. Option C is misleading, as inflation protection is available to individuals of various ages. Option D is somewhat true but doesn't capture the full scope. While it may increase premiums, it does not guarantee a larger payout, as the benefit amount will also depend on the policy terms and conditions. Question 26. What is the typical waiting period for long-term care insurance benefits to begin after a claim is submitted? A. 0 days. B. 30 days. C. 60 days. D. 90 days. Answer: C. 60 days. Explanation: many long-term care insurance policies include a waiting period, often referred to as an elimination period, which can range from 30 to 90 days. A common waiting period is 60 days, meaning benefits will start only after the policyholder has met this duration of care. Options and B may exist in specific policies but are less common, while option D reflects a longer waiting period that some policies might have. Question 27. Which of the following would typically be considered a benefit trigger under a long-term care insurance policy? A. A doctor's recommendation for long-term care. B. The inability to perform at least 2 activities of daily living adults. C. A specified diagnosis of a chronic condition. D. The policyholder reaching retirement age. Answer: B. The inability to perform at least 2 activities of daily living adults. Explanation: benefit triggers in long-term care insurance are specific conditions that must be met for benefits to be paid. The inability to perform a certain number of DLS, usually 2 or more, is a common trigger for policy benefits. Option A may support a claim but is not a formal trigger, while option C alone does not guarantee benefits without associated functional limitations. Option D is irrelevant, as age alone does not activate benefits. Question 28. What is a common exclusion found in long-term care insurance policies? A. Care received in a nursing home. B. Care related to substance abuse. C. Home health care services. D. Custodial care for chronic conditions. Answer: B. Care related to substance abuse. Explanation: long-term care insurance policies often exclude coverage for services related to substance abuse or addiction treatment. This means that if a policyholder requires care specifically for substance-related issues, those costs would not be covered under the policy. Options A, C, and D typically fall within the scope of coverage provided by long-term care insurance as they relate to legitimate long-term care needs. Question 29. Which of the following best describes a guaranteed renewable long-term care insurance policy? A. The insurer can cancel the policy for any reason at the end of the term. B. The policyholder can renew the policy without having to provide evidence of insurability. C. The premiums can be adjusted based on the policyholder's age at renewal. D. The policy provides a fixed benefit amount that cannot change. Answer: B. The policyholder can renew the policy without having to provide evidence of insurability. Explanation: a guaranteed renewable policy allows the policyholder to renew their coverage regardless of changes in health or other factors without having to provide additional proof of insurability. This feature offers significant security and peace of mind. Option is incorrect. Guaranteed renewable policies cannot be cancelled by the insurer arbitrarily. Option C may apply to some policies, but it does not define guaranteed renewable status. Option D is misleading. Benefit amounts can be subject to changes based on policy provisions. Question 30. What role does the free look period play in long-term care insurance policies? A. It allows the insurer to review the policyholder's health records before approving a claim. B. It gives the policyholder a specified time to review the policy and cancel it for a full refund if unsatisfied. C. It determines the waiting period before benefits can be accessed. D. It specifies the duration of coverage under the policy. Answer: B. It gives the policyholder a specified time to review the policy and cancel it for a full refund if unsatisfied. Explanation: the free look period is a consumer protection feature that allows new policyholders a specified time frame, usually 10 to 30 days, to review their long-term care insurance policy. If they decide they are unsatisfied for any reason, they can cancel the policy and receive a full refund of any premiums paid. Options A, C, and D are not accurate descriptions of the free look provision as they pertain to other aspects of insurance policy operations.